Hello everyone, my name is Mikha Valentino. I'm from Management 2028. I'm here to, my NPM is 224 11109. I'm here to presenting about cognitive biases in accounting dari mata kuliah akuntansi keprilakuan. Why good accountants make bad decisions? In the world of accounting, where precision and objectivity are paramount, cognitive biases can insidiously undermine in the most seasoned professionals. This unconscious mental shortcut can lead to flawed decision making, resulting in significant financial errors and ethical lapses. This presentation explores the pers- pervasive influence of cognitive biases in accounting, examining, examining how they manifest in real world scenarios and their constantly consequences will uncover a specific example of accounting errors stemming from their best biased thinking and delve to impact on the stakeholders. Legal ramification, ethical consideration. Finally, we will outline our proactive strategies of mitigating cognitive biases in accounting, empowering professionals to make more informed objective decisions. Next. Confirmation bias, saying what you want to. The bias. Confirmation the bias is tendency to seek out, interpret, favor, and recall information that confirms one pre-existing beliefs that hypothesis in accounting. This can manifest to selectively focusing on data and support this desired outcome, while ignoring track the theory evidence. For example, during mergers of acquisitions, accountants might overvalue assets to justify the deal, ignoring red flag and the suggest to lower. Enron's inflated asset to valuation which added over $40 billion to their balance sheet serve a stark reminder to perils of the confirmation bias and mitigation. To mitigate confirmation bias, accountants should actively seek out, seek out dissenting options to embrace the role devil's advocate. This involves challenging assumptions, considering alternative viewpoints, and engaging in rigorous data analysis to ensure objectives. Answering bias. Getting stuck on a number, initial number. Definition of reliance and initial information is the anchor. In relevant adjustment, example budgeting based on the last year's numbers regardless. Number three is inaccurate result. Impact inaccurate forecasting and missed opportunities. Anchoring bias describes to the common human tendency to rely too heavily on their first piece to information offered the anchor. When making decisions in accounting, this can lead to inaccurate forecasting, budgeting errors, and missed opportunities. For instance, basing next year budgets solely and on last year the figures, without considering changing market conditions and internal factors, can perpetual inefficiencies behind their growth. Kodak's slow transition is a digital photography, partly due to their attachment to a traditional film market, illustrates the dangers of anchoring bias. Accountants can mitigate the bias of challenging assumption using multiplayer reference point to conducting through the research of ensure a comprehensive understanding of the situation. Ablative heuristic, what comes to mind first? In the top of the triangle, we have overemphasis. In the top, we have overemphasis. Overemphasizing is importance to readily available. In the middle, we have overreacting. Overreacting to reason. In the bottom, we have risk. Train 2008 financial crisis offers estimating risk. The availability of refers to tendency of estimate the importance of information that readily available in our minds. This can lead accountants to make decisions based on their recent or memorable events rather than objective data. For instance, accountants may overstimulate the risks of fraud, and they have recently encountered an high profile fraud case, leading to overly conscious or inefficient inefficient practice. The 2008 financial crisis exemplifies this bias as a widespread panic lead to an overestimation of a risk and subsequent credit crunch. To combat the affability heuristic, accountants should prioritize statistical data, long-term trends, and comprehensive analytic analysis of accounting evidence and recent events. The ripple effect consequences of biased decision. Inaccurate reporting. Biased accounting leads to inaccurate financial statements. Stakeholder impact. This impacts investors, credits, and employees. Ethical problems creates a legal ethical implementation. Cognitive biases in accounting have a far-reaching consequences, creating a ripple effect of impact various stakeholders. Biased accounting practices can lead to inaccurate financial statements, which can mislead investors, creditors, and other users of financial information. This can result in a poor investment decision, financial instability, and even corporate failures. Moreover, biased accounting can also legal have ethical implication, potentially leading a lawsuit, regulatory sanction, and reputational damage. The Sarbanes-Oxley Act of 2002 was enacted to address the accounting fraud. Therefore, it is crucial of accountants to be aware of these potential consequences that take steps to mitigate the influence of cognitive biases in their work. Mitigating cognitive biases are proactive. Awareness and training established comprehensive training programs and educated accountants about the nature of impact cognitive biases. And the second one is independent reviews. Implements independent reviews of audits and accounting practices to identify the correct potential biases. Diverse team fosters diverse teams is varied backgrounds to the perspective to challenge biased thinking. Structured process and adopt the structured decision-making process that promote objectively and minimize the structure of biases. Mitigating cognitive biases in accounting of requires a proactive and motivated approach. Organizations should invest in awareness to training programs, to educate the accountants about the nature of impact of these biases. Independent reviews and audits can help identify the correct potential of accounting practices. Creating diverse teams and varied backgrounds and perspective can challenge biased thinking and promote the objective decision making. Embracing skepticism and fostering of culture of continuous improvement and are also essential for minimizing the influence of cognitive biases and promoting sound financial reporting. I think my presentation already over and I will close my presentation. And thank you for everyone for the time. See you and goodbye.